There we go. Sam, I think we are live.
I think we are too.
Welcome, everybody. Welcome to this week's Happy Half Hour with Carolina Retirement Planners. I'm David.
I'm Sam.
And we are the partners in the Carolina Retirement Planners. If you have just joined us for the first time, for the past 40 some weeks or something, we have, how many weeks has it been?
This is number 41.
41. This is week 41. Ever since COVID, we haven't been able to get together with folks. So we said, let's tell everybody to get their favorite drink and come join us at 4:30 on a Thursday, and we'll talk about something and have some fun. So that's what we're going to do today. And behind the scenes here is Amy. In fact, let's introduce ourselves with our drinks. I am drinking actually herbal tea as is my custom, because I found that if I drink much stronger, it makes for the half hour degrades, but there is something stronger in my future. What are you drinking, Sam?
I have a French white wine open from the Loire Valley. It's a blend of several grapes.
Okay.
I used it to make a risotto with the other day.
And Amy, do you have a drink tonight, to this afternoon?
I do. It's in a funny little glass, but I am drinking the same thing I did last week. It's one of those cactus, pear, light beers. I don't know, something. Yeah.
Okay.
It's not offensive.
Amy is the one who makes it all work. She's behind the scenes getting our Zoom meeting fed into Facebook and all this stuff. So she's with us too. And I see that Martha has joined us, and Top Fan Miranda has joined us too. Two regulars here every week. So has Bill, another regular. By the way, if you're here, go into the chat and say hi. We won't.
Hey, Mom.
We won't know.
Mom's here.
unless you say hi. And actually, today is, we always like to talk about what national day it is. And there's two national days today. What are the two national days today?
Well, it's tax day, or it would have been tax day. So if you're freaking out about getting your taxes done today, don't fret, you have another month.
Yeah, in case you hadn't heard, they extended it a month, but it's also, what was the term we use?
It is National Husband Appreciation Day.
National Husband. I'm so glad my wife is here on with so you remember this is not. So all you ladies, if you're out there with your husband, give him an extra hug or something tonight to show him that you appreciate him, because today's the day.
I appreciate my husband every day. But I'm not going to tell him that it's Husband Appreciation Day. Y'all keep that quiet.
That's right. He is a saint. He's just like my wife.
Totally texting him. I'm gonna let him know.
Anybody put up? Nadine is here, and
Pat. Hey, Pat and Kathy and Lynn, welcome.
Yeah, and Kim. Hey, good to see you, Kim. Or
hey, Kim.
You're here at least. So and yeah, we've got been a nice week. Great weather this week. I just got my second shot a couple hours ago. So if I don't feel, if it doesn't affect
me, head hit the keyboard, you won't.
Yeah, if it doesn't affect me, I'm going to head up to the cabin in the Uwharrie Mountains over the weekend and kind of enjoy the weather up there as well. And the hummingbirds have come back, and so sit there on the porch, watch them battle it out over the hummingbird feeder.
Yeah, I've got my feeders up in the back, and they have up at your cabin, you've got like swarms of them. We've got kind of, they kind of flit in and out, and it's really nice. But they're there. They come and they love it right in the evening, just kind of flit up there. And
I think isn't that Amy's mom?
Yes. Teresa's here. That's my mom.
You're getting it.
Another top fan, Brent, is here.
Richard's my neighbor.
Yeah, yeah, that's right. He's right
If
next
I
to
looked
you.
out, it's right.
Been a client a long time for us. Carol's here. Clancy is here. Hey, Clancy, good to hear from you. And Ellen, Ann.
Hi, Ann and Dawn. Hey, y'all.
So, and what is our topic today, Sam?
Well, our topic today isn't one of our sexiest topics, but it is something that we feel is important and we get asked about a lot. And there are, in the last few years, and even, constantly, they are making improvements in this industry, and that is long-term care.
In the last few years, there's been a little bit of a revolution in the options available. And I'll tell you, it's one of those topics none of us like to think about, because and it's even more interesting because as the more technology goes, the longer we last, the longer they keep us going, the more long-term care can be a factor. But so I know this is a topic people want to know about though. So we're gonna go through and kind of, at least on a high level, give you an idea, some of the options. And I'll do this part. This is kind of the ugly part. These are commonly called the activities of daily living.
And you can see, normally we're able to have like a really fun, example on the whiteboard and, something cute, but it's just, there's nothing cute. So we're just going to go ahead and give you all the information we have and give you,
So one thing to know, to qualify for long-term care, you have to, the general rule is you got to be unable to do 2 of these 5. They're eating, bathing, dressing, getting up and down, walking, everybody's favorite, which is continence and toileting. There's must be some little difference there, but it's, when you can't do 2 of these 5, you're generally considered
of the 6.
Of the 6 rather. So you're considered a candidate for long-term care, and a lot of the policies will then kick in. So this is kind of part of the fun part of long-term care. Also want to talk a little bit about Medicare versus Medicaid. Now, I know a number of people that are on the call are on Medicare. Medicare is the government health care program that, basically you get sick, it pays the doctor bill. However, it only pays the doctor bill if you're expected to get better. If you are, you can't do 2 of those 6 and you're not expected to get better and you need constant care, well, then Medicare stops paying. It's like a 30 or 60-day period it'll pay, but it'll soon stop paying, and you're expected to pay yourself. The government says, and our country says, look, when you're old and you need to go into a nursing home, that's your responsibility. You've got to pay for it. Now, what happens if you run out of money? Well, then you go on Medicaid, which is another program, but you got to qualify for Medicaid. Can you imagine, Sam, what this $130,000 is?
I don't know, Dad, you tell me.
Okay, let's say you're out there, you're a married couple, and let's just always like to pick on the man. So let's say the man has to go into a nursing home, had a stroke or whatever the case. The family will have to spend their money down until they have about $130,000 in a house left. And then the government will start with Medicaid, will start paying his medical bill. And so basically, and if there's just one of you, you'll have to spend things down to, like, I think it's $26,000. So basically, the government, we're the society saying it's your responsibility, and before the taxpayers pick up the bill, you've got to pretty much exhaust all your money. So just to make it clear that what the difference is, Medicare versus Medicaid. So you want to talk to a little bit about traditional long-term care, Sam?
Yeah, so there are a number of options that you have for long-term care. Now, there are still a few traditional long-term care policies out there. Largely, these have gone away. There's a handful that you can still get, but if you do decide to select one of these, they're use it or lose it. If you pay the premiums each year, each month, however you choose, but if you don't need long-term care, all those premiums go away.
I often liken it to fire insurance. We all pay for fire insurance. So if our house burns down, they'll replace it. No one wants their house to burn down. You don't want to use the fire insurance, but boy, you hate writing all that. You hate writing those.
Yep. All right. And the other thing about traditional long-term care is that your premiums can go up. And this is what, whenever people think about horror stories about long-term care, this is what they're really talking about is, you're paying so much a year and you're used to that. And all of a sudden they hit you with a 50% increase. And so that's one of the things that people don't really like is that you're putting all this money into something you may never use and your premiums can go up at a moment's notice. So that's traditional long-term care. And these days, unless you already have one and you've had one for a number of years, we don't typically recommend these policies.
I'll tell you, if I showed you the policy, nobody would buy it. I wouldn't buy it. Now, here's another thing. If you've got one of those old policies, an old Genworth policy, even though the premiums may be going up, we often encourage people to keep them because they ain't making it like that anymore. They underpriced them originally. They didn't think people were going to live that long. They didn't think, the cost would be that high. They didn't think people would keep them, and people kept them. So, but you need to think, and we often talk to clients who have one and the premiums come up, and we look at the different options they have and help them make a decision. But boy, like I say, I usually tell people, if you can afford the premiums, keep paying them because you paid all these years and they're not making them like that anymore. So,
yep. If you don't already have long-term care insurance and you're shopping for it now, traditional long-term care insurance is likely not going to be the best fit for you. Okay. So what we've kind of covered this on the surface in the last few weeks, but the option that's going to give you the most flexibility is a life policy, a permanent life policy that either has a long-term care or chronic illness rider attached to it. My dad put up one of his favorite things in this world is a Swiss Army knife. He doesn't go anywhere without it. It is the Swiss Army knife of policies. And
that's right. I've carried one for certainly all the years since I got out of college, and I don't know when.
Yes, all right. You can put it away. We all know, we see it up there.
Okay.
I'm hurrying because I know how much we still have
That's
to cover.
Right. Okay, keep going.
All right. So this is going to be the best option for you if legacy and wealth transfer is one of the most important things. If you are already planning on leaving money to your kids, your grandkids, your spouse, if that's something you're already wanting to do, could be a really good option for you. It can kill 3 birds with 1 stone. This could be really good for tax planning. If you have a big IRA, you could be taking each year, kind of doing a conversion with that, taking that IRA money and using it to pay your premiums and moving that money into the tax-free world. So you could be doing that for tax planning, legacy planning. So the money's going to go to your spouse, to your heirs. And then as we like to say, it used to be that to get any benefits from your life insurance, you had to die, but that's not the case anymore. Now they have these riders where if you can't do 2 of those 6 acts of daily living, they will allow you to what they call accelerate the death benefit. So they'll let you take out a little bit each month to pay for your long-term care expenses. And if you don't, whatever you don't use for your long-term care expenses will still be passed on as a tax-free death benefit to your spouse, to your heirs, or whoever you designate as your beneficiary. And the way that we typically structure these policies are as a single pay, a 5 pay, or a 10 pay. One of the ways that we like to really do this is to go ahead and get these premiums out of the way and lock in your benefits. So it's not inexpensive, but that's typically the best way to get these to fund these policies, especially if you're using these for tax planning. You know, that's typically when your RMDs are going to start kicking in as well.
Okay, so okay, that is the first one. What's the next option? Sam, tell them about asset-based long-term care.
Yep. So next is the asset-based long-term care, and this is the best option if you are more concerned with your long-term care and you are not as concerned with leaving a legacy. You say, well, you know, the death benefit is nice, you know, that's fine, but I really want to maximize, I want these premiums to go to maximizing the benefits that I can get for long-term care. That's my primary concern. And this would be the right choice for you. You still get the tax-free death benefit. It's just going to be smaller and your long-term care benefit's going to be bigger. These also are going to do, we prefer to do these as single pay, 5 pays, or 10 pays. And one of the cool things about these as well is some of them have a return of premium option. And it's usually after the 10th year, in your 11th year, if you say, you know what, I don't actually need this money for long-term care, or I want to do something, I want to take this money and run for whatever reason, you can get that money that you paid into it back.
Let's say the government nationalizes long-term care and now you got government benefits. You could get it back. Some of them you can get the cash sooner too. Boy, we could go forever if we win all the options. They're coming up with more all the time.
Exactly. And that's not for every policy. If a return of premium option is something that's really important for you, that would be something you would want to talk about ahead of time. Again, the long-term care arena now is filled with all of these really cool options, but they're expensive and there's a lot of bells and whistles and there's a lot to kind of navigate inside of here. So it's really important to kind of zero in on what's important to you. Also, before we move on from here, they do have a few policies where you can actually share the policy with your spouse and have a shared benefit pool. I've found with these policies that you have a few more limitations and a little bit less flexibility, but it's overall cheap. It's going to be cheaper than it would be if you each had your own policy. So that's something that you have the option of, and it's kind of cool to be able to explore if that could be good for you as well.
Then you also have something that, you know, I know we have used a lot over the years. You know, there's a lot of indexed annuities that have income riders where you give them so much money, they put it into a big pot and they're going to grow the pot every year, but they're also going to pay you an income. And that'll go for as long as you, or usually you and your spouse, are alive. Well, one of the things these annuity companies did is they said, gosh, a lot of people don't have long-term care and they could use some benefit. So what they did is they said, if you or your spouse can't do 2 of those activities of daily living, we're going to double the amount of money that you can get. Usually it goes for 5 more years or until the pot runs out, and then it'll go back to single later when after that period of time, or if the person that needs long-term care no longer needs it for whatever reason, then it goes back. So it's one way, one spouse, we can get extra money if one spouse needs it. The other thing neat about this is there is no health check. If you're not healthy, you usually won't be able to get any long-term care because they do at least some basic check. And I was just talking to someone the other day, and that person has some health issues that they're really worried will cause them to need help, need care. They like to bring someone in the house. No way we can get them a long-term care policy, but they also need income. So we may be able to use one of these with the income doublers to at least help contribute to that. It's not going to be a full solution, not quite as much money, maybe depends how much you have, but this is good if instead of saying, wow, I have more money than I need, I want to pass money on, you say, wow, I need income from my savings. This is a good strategy to get your income and your long-term care too. So that's the income riders. You can also self-insure. We'll talk a bit about long-term care costs, but let's say that you think, wow, in the future, I may need $200,000 for long-term care. Well, let's say I got $1 or $2 million. Should I buy a long-term care policy, or should I just say, man, if it happens, I'll take it out of my pot? So what, or, it's insurance is insurance. You can say, I'll take the chance and I don't want to take that much out of my lifestyle. I'd rather run the risk that I'll have to pay it myself. So you can self-insure.
Okay. So we wanted to go over some different terms and things to think about that we feel are important for people to know about in the long-term care space. The first that I think is incredibly important is indemnity versus reimbursement. Now, indemnity policies mean once a doctor qualifies you as not being able to do 2 of the 6 acts of daily living, the policy will just send you the monthly benefit. There's no strings attached, that you can spend it at that point on whatever you want. And this is really important, especially for home health care. So if you think that in the future, you may want your spouse or kids or somebody in your family to take care of you at home, and be able to spend your money towards supporting them and that, then an indemnity policy is going to be really important for you. So it gives you the most freedom, it gives you the most flexibility, and we typically like the indemnity policies. Now, reimbursement policies, this is where most of your traditional long-term care policies are going to live as well. These policies, you are going to send your bills to the company that you're insured with, and they will reimburse you for the bills that they see as qualified. And where, again, with home health care tends to be one of the most important sticking points of this. Some reimbursement policies won't cover home health care at all, and all reimbursement policies will not cover home health care if you want a family member to take care of you, unless they're qualified.
Unless they actually get trained and certified, they won't reimburse them. So you'd have to bring in a certified, nurse, home health care practitioner.
Exactly. So the reimbursement, they'll only spend it on the bills that they see as qualified for long-term care. So whenever we look at this, at first glance, you say, well, why would I want reimbursement? I would definitely want indemnity. There's a few reasons why you may want reimbursement instead. And now we go to the next slide. I think some of those are there. Some questions to ask yourself are, yes, do you want your children or spouse to be able to take care of you? And do you have family that you trust to manage your care? Even if they're not the ones who may be taking care of you, do you have people in your life that you trust to make sure that everything's on the up and up? Do you have a son or daughter who has a gambling problem? And if you needed to go into long-term care, they would, you're worried that they might stick you in a closet and take all of your long-term care money and go out and gamble it at the casino.
Well, lock you in.
That's like the worst case scenario.
Bedroom and
Yeah.
diaper once a day and go spend all your money and
Exactly. So if one of the things that you may be concerned about is having people you trust in your life, if you were to need it, using those that money wisely, then reimbursement may be the right choice for you, because you know that that money is going towards your qualified care. Some other questions whenever you're trying to figure out what might be right for you. Are you okay with, paying over a set time with a single pay, a 5 pay, a 10 pay? Or are you in a situation where you would need or want to pay over a lifetime? And determining which policy is right for you. Are you willing to sacrifice some of your long-term care benefits if it meant more insurance benefits go to your spouse or heirs upon your death? And then do you have an idea of what kind of benefit you'd like or how much premium you'd like to put into your policy? And this is where it gets really tough, is you're like, how much do these cost? And it can vary widely. They're not cheap. And depending on what you're looking for and how much, the frequency you want to pay for, the benefit that you want, how many years you want it to get paid over, it's all over the place. So it's important to try to start thinking about how much you would like your benefit to be. Now,
the life insurance works real well when you're in your 50s. As you move through your 60s, it becomes less compelling, but then it depends on your situation as well. That's where you just got to get some, just go look at it, get some quotes and see what works. And
absolutely. So these costs that I've pulled, you can go to Genworth has a website where you can plug in your zip code and it will tell you the current cost of care in your area. So in the greater Wilmington area, these are the costs of these different long-term care options. So to have a home health aide is about $4,000. A private room in an assisted living facility is about $5,800. Yes, these are monthly premiums a month. A private room in a nursing home is just under $8,000 a month, and a semi-private room is about $7,000 a month. Now, on average, women need long-term care. If they use long-term care, they will go into long-term care for between 2.5 and 3 years. And males average between 1 and 1.5 years. So that's a kind of a good starting place, is to look at these numbers and say, okay, this is what it could cost a year for potentially this many years. Do I want to insure for this whole amount? Do I want to insure for a portion of it just to kind of cover some of these expenses and then make up the rest with, our pension, Social Security, our own other assets? Some of the other things to think about are, do you have a history of Alzheimer's or dementia in your family? Is this something that you are worried about for yourself? Are you worried about potentially needing long-term care for an extended period of time? If you're in your 50s or very early 60s, inflation may be an issue. So right now, these are the costs, but by the time you're 80, when you may need long-term care, the cost may be very different.
And some of them have inflation built in and some don't.
Yeah, so the asset-based plans have different like little tables of inflation calculations to make it really simple, but it's different with life policies. They don't have those. You kind of got to do it yourself. And then self-insuring plan, if you're going to self-insure, you should ask yourself, where am I going to draw those assets from first? And what about if I'm married, where is my spouse going to draw them from?
And we had a couple of questions. Patrick asked, was the 130 limit for couples or single? It's for couples. Single is like 25,000. And, you know, someone asked, are they affordable? Again, it's all over. As you get older, the life insurance becomes less affordable. The annuities become better because they pay you more the older you are. So it's just it's a mishmash. Now we have, if you want to know more, we have a little brochure that goes over long-term care, and we've also included the numbers from Genworth that we showed you there. And Amy, how can they get a copy of this?
What they need to do is they need to send us an email with their name and their mailing address to info@carolinarp.com. I will put that in the comments here on Facebook, and we will get that. Or if they are on our Happy Half Hour email list, they can reply to one of the emails we send them with that information as well, whatever's easier for them, and we'll get it mailed out next week.
And if you want to look at quotes for yourself, give us a email or a holler. We'll see if we can get that into the works. Like I say, things are changing rapidly, more stuff all the time. More people are leaving the traditional business, and a lot of people are getting into these new hybrid asset-based policies. So Sam, it is time, I think, for our favorite part, isn't it?
It is. It's time for the wine drawing. And so for everybody who has not been here and heard my spiel before, to enter our wine drawing, all that you've got to do is throughout the week, we send a few different email blasts out. You respond to those and you let us know a feature topic that you'd like us to cover or questions about this week's topic that you have. Or you can just say, enter me into the wine drawing. You may also RSVP that you are attending to our Facebook event. You can also share this with a friend by either forwarding the email, sharing the Facebook invite, and just letting us know, and we'll enter you in the wine drawing again. Pretty much just any way that you want to get in touch with us.
Can I chime in real quick? One thing. I see that we have a couple of new people, or some names that I haven't recognized that are watching. If they are not on our email list, they can also use that info@carolinarp.com to send us an email, and I will make sure that they get added to the list so they can stay informed of all of our upcoming events.
And everybody, a month or so ago, we updated our website. CarolinaRetirementPlanners.com has some new videos on there. Take a look. Let me know what you think. And under events is a listing of all 40, now 41 of the past Happy Half Hours. And you can go watch them on YouTube anytime you want, and share it with your friends. So that's another change. That the website I think is pretty interesting. Some good little videos there to watch. So that's another thing there. So okay.
All right, what can I do? All right. So our winner this week of 2 bottles of wine delivered directly to your door from Fermental Bottle Shop is, she enters almost every week. I think I saw her here, so I hope she's here. Diane N. So congratulations, Diane. You have.
She is here. I know who you're talking about. I saw her. Yep, she's here.
I saw a comment. So congratulations, you are our wine winner this week. And for those of you who did not win, do not give up hope. I love putting your name in this bin right now, and continue to send in your comments and questions.
Now, next week, it turns out, I think last Friday night, the IRS announced or put out a bulletin making further changes to the demise of the stretch IRA. As we talked about earlier, the stretch IRA is dead. and they're monkeying with it more and arguably making it even more worse and more confusing and more dangerous. So we're going to spend next week talking about those changes, so you can be filled in on what's going on, and there's some real dangers to look out for there that I think we will highlight at that point. So next week, more on the death of the stretch IRA and how the IRS is pounding even more nails into the coffin. So we will see you then. It was great seeing everybody, and everybody have a good week
with us.
Have a good week. Cheers.
Cheers. Cheers, everyone.